Investments. I'm really excited about this program. My name is David Scherer. I'm co-CEO and co-founder of Origin Investments. We have about 500 attendees. I don't really know the demographic, but I think about half are probably investment partners, and half are people that just want to learn more about Origin, which is great. Let me just start by saying, whether you're a partner or not of Origin, our mission is to create better educated investors in private investments. Of course, we're focused on real estate, but the principles of how you evaluate a real estate manager would apply to a private equity manager, a venture capital manager. It's very, very broad, and we're committed to this. If you're at all intrigued by what we go over today, please go onto our education section. We have over 250 articles and videos. They're all written or produced by us. And we want you to become better educated, whether you invest with us or not. It's so important once you've worked so hard to acquire wealth to maintain it, to grow it, to protect it. I can tell you, I told this story to our team. We have 45 team members, and I was talking about the importance of our clients, and we have 3,000 clients now, one of which is my mother. And my mother was a school teacher, and she made $35,000, $40,000 a year, and put myself and my sister through college, and we couponed and made it work. And then when we graduated college, she started saving, and it started compounding, and she became an accredited investor, over a series of years. She doesn't spend a lot of money. And so she could become an Origin client. And, she's doubled her money at Origin over the last 5 or 6 years. And that's significant. And she did it in a way that did not expose her to the types of risk that you really don't want to be exposed to when you work that hard to accumulate it. These are real people. Our 3,000 clients are real people, and we want to protect and grow their wealth, of course, alongside ours. And so please, we had about 36 questions prior. I'm going to try to incorporate those in the presentation. If you don't feel like they were answered and you emailed them in, thank you for doing that. Just go to the chat box at the bottom, the Q&A box, excuse me, and re-ask the question. I'll answer it. And then, of course, if you have any live questions, please ask them. I'm going to try to have 20 to 25 minutes dedicated to Q&A. I already see there's a question, so thank you. We will cover all those in just a bit. So let's get started. So with Origin now, we've been around for 15 years, and we have a tremendous amount of data. We have 8 funds, many of which have been fully realized and sold, and the returns to the investors have happened. And then others are open-ended funds, meaning they raise in perpetuity. But what we're really proud of, what I'm going to focus on here, isn't the size and scale. We've become a pretty big company. 2,900 investors. It's actually, I think we just crossed 3,000. If you're an investment advisor, we have 60 investment advisory partner firms now who invest their client capital here, at least their real estate exposures. But what I'm most proud of is that we're a top decile manager. And that designation, which is done by Preqin, it doesn't designate a fund. It actually designates all activities since 2014. So we're talking about a tremendously large data set that spans 4 funds. And we're proud of that. That means that we've protected and grown capital in a way that was better than 90% of other managers. And so we're very, very proud of that. Next slide, please. So the first couple slides, I just want to cover the importance of, and I know there's a lot of data on this slide, but I'm going to start very broad. In your portfolio, you don't want all of your investments to be moving at the same pace in the same direction. And so that was most obvious this year. Typically, people are in stocks and bonds, and they don't correlate historically. Generally, bond yields don't move in the same direction as stocks. So when stocks are going down, Bond yields are also going down, which means the price of the bonds are going up. And so they offset. And that's a good thing. You don't want your portfolio all going down at the same time at the same rate. What we found in an inflationary environment is that a stock and bond portfolio actually does correlate, and that's a bad thing. And so if people are in stocks and bonds and that's your portfolio, you've seen bonds lose value. They've lost anywhere from 8 to 15%. And you've seen stocks, stocks have rallied quite a bit in the last month, but let's just say they're down 15 to 20%. And so both sides of your portfolio are losing. And so what actually does do well in an inflationary environment? Real estate. And what kind of real estate? Essential real estate. Is there a more essential real estate than a place to live? No. And so, that's why all we do is multifamily. It's not just because it's an inflation hedge. I also just believe that 10 years, 20 years, 30 years, 50 years, there's no way to disrupt the need for a place to live. That won't change. But everything else sure can change. We've seen it in retail. We've certainly seen it in office now. Office demand is being taken up by a virtual substitute. We're having this wonderful virtual meeting right now. Used to be in person. You can't do that with housing. And so that's one of the reasons we're there. So let's talk about portfolios. And if you focus on the right, this is a huge data set. This is 21 years of data. And what we've done here is we've compared the typical on the far right, 60-40 portfolio. That's 60% equities, 40% fixed income. We've compared those returns and those standard deviations. Standard deviation is a measure of risk. You want to have a lower standard deviation because it connotes less risk. So less is better than that. And then the Sharpe ratio is simply the return as the numerator, the standard deviation is the denominator, and it's something that all fund managers and professional investors really focus on. You want to have the highest Sharpe ratio you can in a portfolio. And so if you see on the far right, it's a 60-40 stock and bond portfolio. And then in the middle, you see that over the last 21 years, we shrunk down the equity from 60 to 50. We shrunk down the bonds from 40 to 30, and we inserted multifamily real estate. So over this huge data set, what would have happened is a 13.9% return in the typical portfolio would have increased to 15.5. The standard deviation would have decreased, which is good, less risk, from 11.6 to 11.1. I would tell you a big reason for that is the dividends are much higher in private real estate, which smooths standard deviation. And of course, the Sharpe ratio is going all the way from 1.21 to 1.44. If you are a professional investor, that's an enormous move. Typically you're trying to tweak portfolios to have Sharpe ratios rise, 5 basis points, 10 basis points. You're talking about 23 basis points here. And if you look on the left, that equates to a 19% higher Sharpe ratio. That's enormous. So that's this large data set. Let's focus on just last year. Next slide, please. So why do I focus on 2021? And I would tell you that if I extended this into the first 2 quarters of 22, I don't have time to keep doing this. I want to move on to other things, but it would paint the same picture. It would actually be even more pronounced because I've seen that data as well. But if you look at 21 was a really good year, really for all asset classes. And so in a 60-40 portfolio, you would have realized a 15.9% annualized return, quite good. But if you had been in a 50-30-20, with 20 being multi, you're going to go all the way up to 18.5. Your standard deviation goes down, but not significantly, from 3.5 to 3.4. But look at the difference in the Sharpe ratio, 2.5 to 4.1. That is unbelievable. And again, that's what you're after in a portfolio. How do you maximize risk return? And that's what the Sharpe ratio is honing in on. 64% higher Sharpe ratio in this 1 year period. And the reason we chose 2021 is 2021 was an extraordinarily inflationary year. The Fed didn't realize it. right? They weren't raising rates yet. They were still saying it was transitory. But the reality is we are in a very high inflationary environment, and multifamily real estate did exactly what it's supposed to do. It completely hedged you from inflation. Why is that? It's because we get to reset our rents every year. We don't have 10-year leases. We don't have 15-year leases. We have 1-year leases. And so as inflation is forcing input costs higher, we can pass those off onto the consumer, the renter. And that's exactly what we saw last year, which is typically our rents grow by 3 or 4%. Last year, they grew by 20%. I've been doing this 15 years. I've never seen that type of rent growth ever, right? And by the way, this year, it's continued, not at that pace, but the first 2 quarters of this year, 6 to 8% rent growth. You know, annualized, that's 12 to 14. That's an amazingly high number. So it's continuing to do what it's supposed to do, which is a hard asset. It's a demand asset. It's an essential asset. And by the way, I don't know, I just learned this recently. I knew that multifamily housing and the price of rental was a huge input into CPI, the consumer price index. What I didn't know is it's over 25% of that input. So when you see CPI going 8% higher, 9% higher, if you're in a multifamily fund or you have exposure, it's kind of a good thing. It means that your rents are really going up a lot, because there's no way CPI can go up in a world where rents aren't going up. It's too big of a part of that index, the cost of housing. Next slide, please. So now we're getting into, if you believe that private real estate and multifamily real estate has a place in your portfolio, and I've explained why, subbing out traditional 60-40 for 50-30-20 is producing much higher Sharpe ratios. If you believe that, I will tell you, you'll never make a more important decision than what manager to select. And this slide is speaking to that. So if you go into private investments and you select a top quartile manager, your average multiple will be a 2.1. That means if you invest $1 million, you'll get back $2.1 million. If you select an average, the median, so let's say somewhere in that sort of 45 to 55% management team, you're going to get 1.45 million back. You'll still make money, but a lot less. And if you're in the bottom quartile, you're going to lose money. You'll lose $110,000. You'll be returned $990,000. I can't stress enough that in private markets, they're inefficient markets. And I define inefficiency as not everyone in the market gets the same information at the same time. A market can be mispriced, but still be efficient. It just means that, you know, if you're trading the S&P 500 or investing in it, everyone's getting information at the same time. There's thousands of analysts. Information is ubiquitous. The market can be way, way wrong about the pricing, but it's efficient. Private markets are not efficient. You don't get information at the same time. You by definition do not. For example, I'll just hold up a state that we're very active in, Texas. In Texas, you don't even have to disclose sales. So if you don't have people on the ground and connectivity to the market, you actually won't even know the prices things are trading. That's the definition of inefficiency. So then we're going to spend the rest of this time talking about how do you hone in on a top quartile manager? How do you increase your probability of selecting that team? Next slide, please. So there's a lot of options you as an investor have for investing in real estate. Again, if you're at all convinced that you should have exposure, there's a lot of ways to do it. You can have direct ownership. You can go onto online platforms and try to vet investments. You can invest in REITs, both public and private. And then there's private equity real estate, which is what Origin does. And that's private funds that are professionally managed. And you need to be accredited in order to have access to them. Direct ownership, I would say that the thing, you need two things to do this at a high level. The first is you have to have domain knowledge about pricing, operations, how do you buy it right, sell it right, manage risk. Do you have, the skill set yourself, or how are you going to vet who's going to run it? And then in addition to that, you have to value your time. Do you want to be collecting rent? Do you want to be, fixing or coordinating the fixing of maintenance items, et cetera? These are all things you have to ask yourself. And then, of course, with direct ownership and online investing platforms, you have to have enough capital so that you can do it 10 times. Because if you told me you wanted to invest in the stock market, but you wanted to invest in one stock, I think we would both agree that doesn't make a lot of sense. I think people intuitively know you shouldn't just go buy one stock. You should buy a portfolio of stocks, an index, et cetera. And I would tell you, real estate's no different. If you're going to put $1 million in real estate, don't put it in one deal. That's violating every premise of portfolio theory. And so you need to have enough capital to buy quality assets and be diversified. And that applies to both direct ownership and online investing platforms. With the online investment platforms, the thing that bothers me about that venue is it's sort of buyer beware. So you show up, they say that everything's vetted, but it really isn't, in my opinion, because their whole model is to make money off, they're sort of like an online mall, and they make money when transactions happen. And so your job is to go on there and vet the management team, the pro forma, the numbers, the domain knowledge, to vet the numbers, to know the ratios, to understand if it's quality underwriting or not. I don't think there's very many people in the world that have all those skill sets. And, the analogy I would make is, I can't fix my car, and I certainly can't, fix my arm if I broke it. I go to professionals who are trained to do those things. But I actually could vet an online deal. I know how to do that because I'm trained in that. And so it really does bother me that there's so much transaction going on, because I think that it's not sound. I'm afraid that people making these investments, they see an IRR, they see a return, and they either believe it or maybe they discount it slightly in their head. But you might see a 25 IRR that if I looked at it, I tell you it was a 3. And that's a very different, and it doesn't take a lot. If I say, okay, well, are they drifting cap rates? No. Are they trending rents? Yes. Okay, well, that's not sound underwriting. What's their expense ratio? 32. Yeah, but the market there is more like 41. What's their taxes? What's their insurance? You have to be able to dig in to these numbers and come up with a really educated idea. And I'm not really sure that they allow you to do that. I would tell you, if you go to online, I would hire a consultant. Obviously, Origin doesn't do that, but if you're going to invest $1 million into a deal, spending $5,000 or $10,000 on a consultant to vet the validity of a business model, it's well spent money. You should probably do that. Real estate investment trusts, I would tell you the public REITs are actually fine investments. They've had very good returns over long periods of time. Stay away from the private REITs. They're very high fee, they're very high placement. There's no reason for you to ever be in those products. I would tell you not to do that. I might get emails later saying, well, yeah, but there's this one private REIT and they have this unique distribution, business model. And I'll take a look at it and, I'll let you know. But I would say in general, I would go to public REITs, not private. The challenge with public REITs is they're going to correlate much more with stocks. And the reason for that is they are stocks. And so public REITs are in the S&P 500. So in corrections, they're going to correct. And private real estate doesn't correlate. Q1 and Q2 of this year are a great example. It's not going down at the same pace. You still have high dividends. And so it's providing much more of non-correlation than a public REIT would, but it is a good product in itself. And then there's private equity real estate, and I obviously am biased. That's what we do. I think that it's a fine product, but here you really do have to select the management team correctly. These are long-term investments. They're illiquid investments. You just don't change your mind and get out. And so you have to really, number one, manage your own liquidity so that you don't 2 years later realize, well, actually, I need that money. You can't just get it back. It's much more difficult. And then you also have to select the management team well. Don't have buyer's remorse in year 3. You won't have the ability to get out. You're part of a company. You've legally signed into that. You're a member in a company that owns real estate, and you need to, just like if you buy a stock, part of vetting that stock is, do you believe in the management team? Do you believe in the CEO and the C-suite? It's no different with a private equity real estate fund. You have to believe in that management team and their ability to execute on your behalf. Next slide, please. So investing in funds versus deals. Again, I have a very strong opinion on this, so I'll make an argument. I started to make it earlier. When you invest in real estate, you want to be diversified. You want geographic diversification. You might want sector diversification. And if you do, that means you don't just invest in multifamily, but you invest in office and hotels and industrial. You can only partner with Origin in multifamily. That's all we do, right? So and by the way, in terms of geography, we're only in the Southeast, Texas, and Southwest. So if you're on this webinar and you said, well, Origin seems compelling, but I really want to invest in New York City and Ohio, we don't invest there. So I can't help you. But if you believe in our Sunbelt strategy, we believe that population will continue to move there. That's the driver of demand in multifamily real estate. We don't think that we're even in the 3rd inning. I think it's just going to keep happening. I also believe that there's a network effect. The more people that move to these cities, the more that the cities are built out with infrastructure, both physical, meaning rail, highway, et cetera. You've already seen that happen in Charlotte. It was rail that extended to the north. In Denver, it was rail that linked the city to the airport, and there's massive development all along it. We're part of that. But you also see it with cultural infrastructure. So as wealthy people move to Florida, and they are obviously, they're going to want the same things that they had in New York, New Jersey, Boston, Chicago. They're going to want nice restaurants. They're going to want the arts. They're going to want universities. They're going to want, and they'll get them. And so every year that the populations move, and in particular, wealthy people move to these low tax states, they're going to replicate what they had before. And I believe that's the network effect that you already see happening. So why would you invest in a fund? It provides diversification, meaning you get a series of deals, 10 to 12, 15 deals, not one. And you have a small interest in each deal, but you're diversified. So if you're selecting the right management team, you believe that if we're going to invest in 15 deals, we'll do well in general. Like maybe one deal underperforms, another overperforms, but you're investing in every deal. And so the total outcome will be, meeting your goals. If you invest in one deal, obviously I'm back to you're on the online mall model. It's zero sum. If the deal does well, you do well. If it does poorly, you do poorly. That's the end of the game. The other thing I'm going to focus on is cross-collateralized promotes. And this is a little bit in the weeds. So if I don't explain it clearly to you, email me directly, david@origininvestments.com, and we can correspond offline. So one of the ways a manager gets paid is what's called incentive compensation or promote. And what that means is, For example, at Origin, if you're in one of our development funds, we charge a 15% promote above a preferred return of, let's say, 8%. Okay. And so if you're in this fund and you invest $1 million, every year, your capital account is increasing by $80,000. That's the preferred return. Because your capital is being used for this investment. And then when we have money to distribute, whether it's from cash flow from operations or refi or sale, first we pay down the preferred return, then we pay down your principal, so we return all your principal. And once that happens, we share in 15% of the total profits of a fund. That's called promote or incentive. And all hedge funds and private equity have this concept. And I would say typically the market is anywhere from 15 to 20%. So I'd say we're a little bit on the lower end of that market, meaning it's better for you. It's a lower fee. But if you're doing deal by deal, so let's say again, you find a deal either online or it's a friend, and you do a series of the deals. Let's say you do 10 deals yourself and you find them all yourself, and they're all different management teams. You're getting diversification, right? You're in 10 deals, you're not in one. The problem is none of those promotes are cross-collateralized. So if 5 deals make a lot of money and 5 deals lose all your money, you'll pay the promote on the 5 that made them, because those are all different management teams. And then the ones that lose your money, obviously lose your money. If you're in a fund and you have 10 deals and 5 make money and 5 don't, all of those deals first have to pay your pref, then have to pay your principal back, and then the management team gets incentive pay. So in a situation where 5 deals lost all your money, 5 deals made money, there's no way a management team would make any promote, right? Because we wouldn't be delivering what we promised, which is your preferred return, your return of equity, and then profits to split. So here's a case where it's not different, it's better, right? Sometimes the world's not gray, it's black and white. You want to be in a cross-collateralized world in equity. And so if I wasn't clear about that, email me, david@origininvestments.com. And by the way, not all fund managers are equal. We cross-collateralize our promotes. That's good for you, the investor. This is a question you should even ask a fund manager. Is your fund cross-collateralized? Simple question. If the answer is no, you don't need to invest there. There's always another manager you can invest with. I don't care how good they seem. There's always someone just as good with better terms for you. Next slide. So we've listed some resources that you have as an investor for vetting managers. So I said earlier, we're top decile. Our resource is Preqin. We subscribe to Preqin. We also give our data to Preqin on all of our deals, all of our funds. But there's others. Case, iCapital, FactRight. Our funds oftentimes are also rated by FactRight. So these are various resources you have. I will tell you that it costs money. It's not a free resource. These are companies that ask for a fee to have a license, if you will. But again, if you're investing a significant amount of money, you might think about how much am I willing to spend to make the right decision, and you have to decide that for yourself. But I'm always a fan of a little bit more research and spending the money up front so you can get it right. Next slide. So these are some of the factors that I think you should think a lot about when you're choosing a fund manager. And by the way, we've written extensively in our education section. You can find these articles about how to choose a fund manager. Funny story. There was an investment advisor that invested in our third fund, and they ran this amazing process on vetting, and it took months. And the final thing they did is they they asked if they could speak to any team members at Origin that had left Origin. And we actually had one team member at the time that had left Origin, and so we put them in touch, and they wound up investing with us in Fund 3. And I asked the woman who had run the process, I said, this was so amazing. It was very rigorous. Like, how did you think of all this stuff? And she said, oh, that was easy. We just took your article and went 1 through 12. And literally, you can find this in our section. There's an article my partner Michael wrote, and there's 12 ways to vet a manager. That's what they did. They used our article to vet us, which was interesting. But some things to think about: track record. That's very important. I would tell you that you really want a firm with a long track record, because it's a big data set. And it also shows you that there's business continuity. It's not a firm that's been around 2 years, 3 years, 4 years. You want to know, because these are long-term investments, that your partner is a long-term, steady, business viable manager. And then the other thing I would say is, I'm kind of segueing the leadership team. The track record has to be the same leadership team. So if a manager has really good track record, but they have a lot of turnover, and the people producing the track record aren't really the people there now, that's a red flag. And again, you have a lot of choices with managers. Why take the risk? You don't have to. Find a team that's produced a lot of great risk-adjusted returns, and it's the same team and the same strategy. And that's kind of the second point: strategy. Does the strategy make sense to you, right? I described ours, macro, right? I can go into the weeds, but the reality is, we believe in multifamily as a long-term protector and grower of wealth, because it's an essential asset. And we believe in the demographic shifts from the Northeast, Rust Belt in California into these lower tax, lower cost states. And we believe in the network effect. And we have infrastructure all throughout these states, and offices and people who built these relationships for 10 years. That's our strategy. And whoever your management team is, they should be able to tell you this concisely. And the longer they're talking, the more you should be questioning why. Alignment's really important. So alignment simply means, how much does the management team invest of their own money in their funds? You want to see that they're making money when you make money. And so, for example, at Origin, that's probably our biggest differentiator. And it's because my partner and I, we're using Origin to protect and grow our own wealth. And we've been doing that for 15 years. But increasingly, our management team is too. And so at this point, we've raised a little bit more than $1 billion of equity for our various funds and strategies. But 7.5% of that, $75 million, is ours. It's the management team. It's us. And so I would challenge, I'm sure I'm not right, but it would be very difficult to find a more aligned manager than Origin. I'm sure there's one out there, but to scale 75 million of $1 billion, that's going to be hard to beat. And what it shows you is, it's not a marketing tactic. We really believe in what we're doing. We believe we have real competitive advantages, and we want to put significant capital into these investments. Next slide, please. Managing risk, as we see this year, it's so important. We've done a lot of webinars on this, but I just want to focus on the first, debt. So simply put, if you're talking to a manager in real estate, you can ask any manager, do they use above 70% leverage? And if they do, just don't invest with them. Again, there's so many managers out there. In my opinion, if you're using more than 70% leverage, it's a good sign that you're not a responsible risk manager, period. And it's probably going to show up in other places. And by the way, and you see on the right, senior debt, preferred equity, common equity. Preferred equity is debt. And so if you're talking to a manager and they say, we only use 60% senior debt, you need to ask them, do you use preferred equity? Do you use mezzanine debt? Because that's also debt. It's just higher cost. And so if that answer is, yeah, 15, 20%, now you're looking at a 75 to 80% levered model. Just don't do it. It's exposing you to risk you don't need to take. Multifamily real estate has never lost money over a 10-year horizon, ever, in 100 years. It's essential. So if you paid the highest price possible in 2007, going into the Great Recession, 10 years later, it was worth more, and now it's worth a lot more. But you know what? If you used a lot of debt, you would have lost the property. And that's the problem. Like, if you marry a quality strategy with a lot of debt, you can actually lose. And I just am a huge believer to stay away from that. By the way, Origin, we issue preferred equity. Income Plus does a tremendous amount, that fund of preferred equity. I love it as a lender. I don't like it as a borrower. And then in terms of the second bullet, does each property have a realistic strategy? What I mean by that is, when I think about Origin, I am responsible for analysis, investment management, and acquisitions in those teams. I view Origin as a holding company through our various funds of 50 to 65 businesses. And those businesses are buildings. And each building needs to have a business plan, and each business plan needs to be realistic, right? Do we have attainable goals? Can we attain them? What are the tactics? How do we measure them? How do we manage risk throughout? And do we have more than one way to win? Is there optionality? And then, of course, the last bullet is, how will we protect capital? And first and foremost, it's protect. It's protect and grow, protect and grow. And that's something to ask a manager. What are your goals? What are you looking to do? And for me, I'm self-made. I've worked very hard, to get to where I am. I want to know that my manager is first and foremost protecting the principal and looking at all the downside scenarios and letting the upside take care of itself. Next slide, please. So we touched a little bit on fee structures when I was talking about cross-collateralization of promotes and incentives. But typically in private equity real estate, there's a management fee. That's annual. It's based on equity. It's usually between 1.25% to 1.5% on equity. If you're being charged 2%, that's really, really on the high end. Excuse me. We charge anywhere from 1.25% to 1.5%, depending on the strategy. So that's sort of the market. And what you really want to be looking at is the gross to net. So in other words, in any fund, X amount of money is made. And if it's made, how much is actually distributed to the investor? And that incorporates management fees, but also the promote or any other fees, and I would just encourage you, we're incredibly transparent. We don't ever want an investor to have a question not asked and answered. But I would tell you, like, some managers, they kind of hide fees and you find out later. And, it's really buyer beware. You have to do your homework. You have to read their PPM, like a PPM, private placement memorandum, and the operating agreement. Those are the terms of what you're signing up to be a member of, a partner of in this company, which is called a fund. And so please review it. And if you don't feel comfortable, again, spend the money to hire a lawyer to review it. And it's money well spent. I think with Origin, it's not necessary because we're incredibly transparent. But if you want to hire a lawyer, people have in the past, and we're totally open to that. The big point here is, if a management team is generating profits for you, you want to understand how much of those profits come to you versus that management team. And there are industry standards that we can, and we write about in our education section again. Next slide. So the tax efficiency is really important to us because we have roughly 3,000 clients. All of our clients are taxed, and I'm taxed, and my partner Michael's taxed, and our management team's taxed. So in all of our funds, we actually really structure them to be as tax efficient as possible. So Income Plus Fund has a subsidiary REIT, Multifamily Credit Fund has a subsidiary REIT. Why? Because part of the 2017 tax bill is you get a 20% deduction on dividends if you run real estate through a subsidiary REIT. And so these are all, at the end of the day, you want profits. And if you're taxed like we are, you want tax efficient profits. Real estate itself is an amazing asset class in the sense that you can depreciate assets and offset income. And so many of our funds, Income Plus, for example, has not had a tax bill since its inception. Although it's been producing, 6% dividends for years. So you're getting dividends without paying taxes, and that's very unique to real estate. Understanding the fund manager's level of client service. So I can tell you, yes, we have a lot of clients. We also have 16 people in client service because we want to make sure that if you have a question, you can either get an email back or a phone call back that day. And, as much as people want to go virtual, and all clients are different. Some clients don't want to talk on the phone. They simply want to have their question answered via email or, even listen to a webinar or something that's been prepared. Other clients want to call you, and we want to make sure that everyone is met where they want to be met with client service. Get to know your management team and understand, because it actually does matter. It's not just the end return, it's the journey. You want to feel like you're heard and your needs are met throughout that process. Remember, a private equity fund of all kinds, it's typically a 5 to 8 year investment. So this is a long-term commitment. You want to make sure you understand what the service is like. Next slide. These are our funds. And what we've done at Origin is we have 4 funds. These are all open for investment. And they span the risk return spectrum. So, starting from the right, Multifamily Credit Fund is our lowest risk fund. We always talk in terms of returns and net. So that's net to you. That's after fee returns. And so we're targeting an 8 to 10% return that will be almost entirely dividends. So that's current pay. It's paid monthly. I'm a huge investor in multifamily credit because it fits my need. I was very, very heavily weighted to growth, and I wanted more income. I wanted more monthly income that I thought was extraordinarily safe. So that fit my goal. Income Plus is a very tax efficient fund. I mentioned before, it has depreciation. It can depreciate assets. It does both common equity investments, controlling interest in buildings or outright interest, as well as preferred equity. And that net IRR is 9 to 11%. Roughly 5.6% right now is the dividend. So about half of that return is paid in dividend. And that's an open-ended structure. And so you can invest in that on a monthly basis. We roll up the NAV and create a share price that has been steadily moving higher. I believe since March of 2020, it's appreciated about 20%. No, a little bit more than that, because I think year over year is 20%. So I'm going to throw this out: 24% since March of 2020. I'm sure Vince and Melissa will correct me later. QOZ Fund 2. So qualified opportunity zones. That's what QOZ means. It's an extraordinary fund. It's building off our first QOZ fund. Again, all multifamily. All this is a multifamily. All four of these funds are multifamily only. It's all we do. But here we're building, we're developing, and then we hold the assets for 10 years to comply with qualified opportunity zone law. There's unbelievable tax benefits for doing this. I'm a really large investor in both of these funds. And the hard part here is you have to have capital gains to attain the tax benefits. So if you have capital gains and you can realize them, so in other words, if you had a capital gain but you sold your business 2 years ago, it no longer would qualify. They have to be capital gains that you've realized in the last 180 days. You can put them in this QOZ fund, and in addition to getting great returns, you're also going to not pay any taxes at all, which is, I've actually never seen anything like it in my career. The reason the target net IRR should seem low, 10 to 12% is low for development. This is a 10-year hold. And so if you think about IRR, it goes down every year, but the multiple goes up. And I can tell you, a 12% return over 10 years is a lot of wealth. And so, you know, if you put $1 million into this fund, it's likely to grow to $2.5, $3 million. Your profit will be $1 million to $2 million. And then you don't pay taxes either. And so it's a niche fund. It's very difficult to scale this fund. It's about 250, 300 million. But if you have capital gains, this is a really interesting fund. And then Growth Fund 4 is the exact same strategy. We're developing in the same markets, Texas, Southeast, Southwest. But this is non-capital gain money because most of our clients, they don't have significant capital gains that can be realized within 180 days, but they do want development exposure. And so here you're seeing a much higher IRR, but it's over a smaller window of time. So 4 to 5 years, you're going to get higher IRR, but less wealth. The multiple won't be as high. It's more like a 2 multiple, not a 2.5 or 3. And I believe that's it, unless I'm missing something, Jeff. Is there more? No. Okay. So how am I doing on time? No, let me look here. Okay, I'm a little bit long, but we do have 15 minutes. And I'm going to jump right into the questions. Okay. So HF, thank you so much. That's so nice of you. So the first question was a thank you, and I appreciate it. Like I said when we first started, whether you invest with us or not, our mission is to make you a more educated investor in private investments. And the things that we're talking about apply to all private investments. And so, thank you. I appreciate it. Richard asked, will we receive copies of the presentation? Absolutely. Jeff, please make a note to send the presentation to everyone. I believe there were, I think you said 460 people who signed up. Make sure everyone gets it. If we have their email, that'd be great. Eric asked a question. I found it difficult to find fee or service advice for vetting a deal like a syndication. How do you locate this type of advisor? That's a really good question, Eric, because I know I said that it would be a good idea, but I don't know, because obviously we have, 18 people on an acquisition and investment management team that do these things. We obviously don't do it. Let me, email me, let me ask. I'll ask around my team. What comes to mind might be a good, inexpensive, and effective way to do this would be to loop into graduate real estate programs. And so I bet students in real estate programs who aren't yet working might want extra money, and that might be a good way for them to make some extra money and for you to get quality advice, but maybe not pay through the nose for it. So send me an email and I'll see what I can do there. Kai asked a question, does Origin plan to offer 1031 exchange? Kai, we have talked about it. There's a way that we can set up something, it's called a DST, Delaware Statutory Trust, where you could 1031 into it and we could execute multifamily, which obviously that's all we do, in a way that would comply. We haven't done it yet because we're really focused on the 4 funds we have and delivering, the top decile results. And there's only so much we can do but it is something we've talked about. I don't think it's something we'll do in the next year, but thanks for your question. And I will say, I said this on another webinar, if you're thinking about a 1031 exchange, do not go into a TIC structure, tenant in common, don't do it. And we can talk offline if you're thinking about doing it, but I can just tell you, we've bought a lot of distressed TICs because they're not set up for any sort of bumps along the road. And you're investing in something that's very high fee and is very structurally weak. And so I would strongly recommend against that. If you want a 1031, buy the property wholly yourself. And then Kai asked, you see 1031 is highly risky because you put all your money in one property. It does violate portfolio theory, you're right. So there's kind of 2 bad options, right? The TIC is not something you should do. And if you put it in one asset, now you have concentration risk. I don't know how to answer that. I wouldn't do it, but it also depends on your own net worth. So if you're worth $50 million and you have a 1031 of $3 million and you buy, I don't know, a triple net asset somewhere that's decent location, and that's one thing. But if you're worth $5 million and you have a $3 million 1031 and you put it in one asset, that's not a good idea. So like everyone's going to be different. And I'm starting to sound like a financial advisor, and I'm not one. I'm a fund manager, so I'm going to stop. Anonymous. Beside incentive fees, how can investor make sense and compare fees? Acquisition fee, financing fee, disposition fee, property management fee. Yeah. That's that idea of gross to net. So the way you can do it is ask a management team, how many profits were there and how much did I get, right? Because all those fees are fees that are eating into the total of the pie. In general, I don't know the name here, it's anonymous. If there's a whole litany of fees, different ways that you're being feed, I would shy away from it, because that to me sounds like a team that's probably trying to obscure fees or overfee. Simple is usually better. If someone's explaining for a long time, that's probably bad, right? I would like as an investor to know, oh, I get charged a management fee. What is it? It's that. What's the promote you charge? It's this. Is there anything else? No. That's more what I would be drawn to, not sort of the litany of fees. Eric asked a question. I never use the last name, so thank you for your question, Eric. What are the red flags or features fund investors should look for in the PPM for multifamily funds? The really easy ones I talked about before. You want to see a consistent management team with a strategy you agree with, number one. Is it the same team, the same strategy? You want to see that their funds aren't radically different in size. They had a $100 million fund. Now they're raising $1 billion fund. Well, you know what? It's a totally different type of sourcing and execution. They 10x their fund. So their track record isn't really applicable anymore. You don't know how they'll do. And so, like, for example, look at our QOZ Fund 1, 270 million. What's our target for Fund 2? 300 million. That's what you want to see. You're getting the same exact strategy with the same team and the same size. That's good. The other thing is you want to see that promotes are cross-collateralized. And importantly, Eric, you want to see that debt is not. And that's a question when you're asking about what's your debt level. So like, what is the fund target? You're including mezzanine, you're including preferred equity. But then the next question is, does the fund ever cross-collateralize debt? Meaning the fund is guaranteeing the debt in addition to the SPE that the special purpose entity that the asset sits in. And if they do, don't invest there. There's no reason to invest in a fund that cross-collateralizes debt. It also shows you the management team either is taking too much risk or doesn't understand risk. You have a lot of choices. There's no reason to do it. Move on. Origin would never cross-collateralize debt. Never has in 15 years, never would. We also don't guarantee that, ever. Why? Well, because it exposes you to risk. There's no reason to do that. And then the last thing we talk about is fees. I'm more interested in value than fees. If a team is really good and you pay 1.5 versus 1.25, it won't matter. We've talked about that before. A top quartile team will double your money. A bottom quartile will lose you money. So the fees really aren't, but I actually believe you can have it all. You should have fair fees and a good team. You should be able to do both. There's a lot of choices. Howard asked a question. Address investor exposure to state income taxes. So at least, Howard, I can't address it as an industry. In our funds, you can elect to be part of a composite K1. And so you'll only be, it'll be rolled up into the K1 once. So you won't have multiple K1s to file. I don't know if that answers your question, but if I didn't, email me, David at Origin Investments. Anonymous, David, thank you. It was an excellent presentation. Awesome. Thank you. I'm glad to see that I didn't put you to sleep. All right, Arjun, do you have any advice for new generation sponsors? And I think that means new managers. I mean, the advice I would have, because we've been doing this quite a while now. Don't take shortcuts and understand that it's going to take a long time if you're new to build a track record. And it's frustrating in the beginning because everyone thinks that they're good and they're ready and they're going to deliver, and maybe you will. But the reality is you need to take in money, make money, maybe 2 cycles, and that takes 5 to 10 years. So believe in the process. It will take time. It is my advice. I apologize if I don't pronounce this correctly. Gurprit said they joined late. Yes, you will receive a copy of the presentation. Please send us your email if you haven't. I'm assuming we have it. I'm sure we have it because you're part of the invite. Glenn asked a question: how does investing in the QZ fund eliminate capital gains on the original investment? Glenn, it doesn't. It defers it. So your original capital gain will be deferred until December 2026. It eliminates the capital gain on the new investment. So just to be very specific, if you made $1 million, you had $1 million capital gain. If you didn't put it into QOZ, then you have a capital gain tax, 2022 tax payable in 23 of somewhere between $200,000 to $230,000. Like that's the capital gain rate. I think it goes as high as 23.9. So call it 200, 240,000. Instead, if you go into QZ, you get to defer paying that for roughly 4.5 years, right? Because it'll be now paid in April 2027, not next year, not April 2023. And so there's a huge benefit to that. I believe that origin can make 8 to 10% on money. And that money, that $230,000, you'd be making that each year. You didn't pay the IRS, you kept it. But the big benefit is the $1 million, if we do our job and we're able to turn that into 2.5 or 3 million, there's no capital gain on that new investment. And that's actually never happened before. There's a lot of ways to defer taxes, but this is eliminating taxes completely. And I would say that the other benefit, which is extraordinary in QOZ, you get to depreciate the asset against cash flow. So you're not paying for dividends. You're getting dividends from the property, but you're not paying taxes on them because you're depreciating it. But then there's no catch up of the depreciation because there's no cap gain. So it's literally, it's a free deferral. Essentially, you're eliminating taxes on dividends with no catch up, which is also unheard of. Usually it's just a deferral until sale. James asked a question, seems like everyone is piling into multi. How am I finding good properties? I totally agree with you, James. We've actually, for the last 3 years, we've purchased two multifamily properties that have done quite well. But in general, we've found that it's overpriced. And so we're heavily into development. We believe that there's been a huge wealth transfer and risk transfer from core buyers of stabilized multifamily to developers. And that's why you see that we're one of the more active multifamily developers in the country. These market dynamics can change, but right now, we think that there's tremendous. I mean, we're building to a 40% margin on average. Historically, that's been 25, and that move has been this transfer. There's too much capital chasing built assets, and so we're focusing on the high margin side of that. I would caution you against funds that are buying value add or existing product right now. I think that the risk return is quite low. Anonymous, who are our top 3 competitors? That really varies by fund. So I would say in qualified opportunity zone, I would say it's probably Bridge is our top competitor. Multifamily credit, Blackstone, Kane Anderson. Blackstone is also very active in a product that competes with our Income Plus fund. And so, on the whole, I would say our biggest competitor is Blackstone. Not so much on the sourcing side. They source much larger deals than us, but certainly on the capital raising side, we have to compete with them because they raise a tremendous amount of capital in real estate. Ivan had a question. I agree with you on my need for monthly income. What are the risks of Income Plus? Is there a chance of making more than 6% monthly dividend? So Income Plus is it's a multi-strat fund. One of the questions, Ivan, we have all of these webinars recorded, so you can listen to the last one. I can't remember if I did it or my partner, but one of the questions we get a lot with that fund is, everything else in the world has gone down in value. Your fund has gone up all year, meaning this year. It was up 20% last year. It's up again this year. I'm going to wait until the price of the fund goes down. And, it is possible that the fund could go down in price, but it would just take an awful lot for that to happen. Because it's so defensively positioned. Most of our capital is either in, the majority of our capital is in preferred equity, which is protected by the profit margin of the development, but then also the capital structure of another 15 to 20%. So you would have to see multifamily correct by 40% before you could really, see that impaired, which is highly unlikely. How unlikely? It's never happened, right? So it would take something that actually hasn't happened to happen. And yes, we have common equity investments, but That's only 40% of the fund. 60% is this sort of highly protected structure. Again, I'm not guaranteeing the fund couldn't go down. It's just unlikely. We run stress tests and it would take a lot. In terms of the dividend, no, the dividend probably won't go past 6%. And the reason is the preferred equity I'm talking about is accrual. And so the way that you're accruing 13 or 14% IRR, but it's not paid monthly. It's paid at the end of the development when the asset is stabilized and refinanced. And so then we get all the money at once. So the money comes back and then we don't return that money. We actually reinvest it. It's an open-ended fund. And so you're going to get 9 to 11%, but 6% will be dividend and the rest will be the accrual of the share price. Again, if you have questions, david@origininvestments.com. I also have a large team of people who can answer these questions. Keep in mind, income plus is very tax efficient. So when you're making 9 to 11%, you're really making 9 to 11%, and that's an additional benefit there. I think I only have one thank you. Oh, HF wants to thank Michael Episcope. Me too. Great partner, 15 years. It's like a marriage. Probably longer than most. And then Nick, thanks for your question. Why do value add funds yield lower returns? Very simple, Nick. Right now, value add is still trading significantly above replacement costs. So think about a residential home. In the same neighborhood, same size home, would you pay more for a brand new home or a home that's 10 years old? Everyone knows the answer, right? You would pay more for the new home. Listen to what I just said. Value add, you get to buy a 10-year-old multifamily property 10%, 20% above replacement cost. That makes no sense. 5 years ago, that wasn't the case. You could buy it below replacement cost. And so one of the things that an investor should do is in high demand assets, multifamily is a high demand asset, you should be looking at replacement costs as part of your investment decision-making tree. In low demand assets, replacement cost is irrelevant. So it can be a trap. So if I say to you, I have an office building near O'Hare and you can buy it 50% below replacement cost. Run away. It doesn't matter because you'll never produce cash flow. There's no demand. No one cares, right? The fact that it can be replicated at a much higher basis, no one will. Who's going to build something to lose money? But in multifamily, the governor is replacement cost because it's always in high demand. But you don't want to buy stuff above replacement cost because as soon as you do that, and value add, it's worse because then you have to put more money into it to have it compete with new. So in value add, it's your basis plus the money you have to invest into it. And if you're above replacement costs, aren't you setting yourself up to fail? I mean, why wouldn't you just build it new at a lower basis? And so that's the simplicity of it, but it's a real compass and governor we use. And it's why we haven't been in value add for the last 3 years. There will be a time where this will invert back. And in my opinion, it won't be that long. I think we'll see that happen in the next few years. Arjun, thank you for the compliment. I really appreciate it. If people have questions I didn't answer, I answered every question. It's 2:10. Thank you. We had a lot of participants live and great questions, and we will send you the recording as well as the collateral. It means a lot to us to make you better investors and give you a sort of a window into how we think. And so I hope I was helpful in that way. Have a great day, everyone.